I want you to picture a number in your head. $200 million. That's the dream, right? You played the markets, you held through the crypto winters, you nailed the timing, and now you have generational wealth sitting in a cold storage wallet. You're set. Your kids are set. Your kids' kids are set.
It's the ultimate success story. Until it isn't.
Right, until the bus factor kicks in. You get hit by a bus, or, in the case of Matthew Mellon, you die suddenly in a hotel room in Mexico.
Right.
And because you were the only person on Earth who knew the private keys, because you were so paranoid about security, that $200 million essentially dies with you.
The Matthew Mellon case is, it's just the stuff of nightmares. And to be clear for everyone listening, this wasn't just a case of we can't find the sticky note with the password.
No.
Mellon was an heir to a banking fortune. He knew finance, but he held around $200 million in XRP, and he had the keys scattered.
Mm-hmm.
Different devices, different names, with absolutely no treasure map for his family.
And while his family is scrambling, trying to hire hackers, trying to guess his passwords, the market is moving.
Oh, yeah.
It's not waiting for the funeral.
Exactly. The market does not care that you're grieving. While his estate was locked out, the price of XRP, it just tanked. By the time they finally figured out a legal and technical path to access the funds, hundreds of millions of dollars in value had just evaporated.
That is the terrifying part of being your own bank. If the bank manager disappears, the vault stays shut forever. But that's just one horror story. There's another side to this, isn't there? It's not just about dying, it's about living and getting sued.
Which brings us to the shield. Most people treat their crypto like cash in a physical wallet. If you're driving your car, you look down at your phone for a second, and you rear-end a Tesla, and the driver sues you for $1 million in medical bills.
And let's say my car insurance, the generic kind, caps out at 50 grand.
There, a judge can start looking at your assets. They see that ledger in your desk drawer. They see the Coinbase account linked to your name, that Bitcoin is personal property.
So it's fair game.
It is absolutely fair game to be seized to pay that debt. You could literally lose your life savings over a bad lane change.
That seems insane. We are talking about institutionalizing yourself today, moving from a personal wallet to an LLC. So how does an LLC actually stop that judge? Is it some kind of magic force field?
It's not magic. It's what's called the corporate veil.
Okay.
It separates you, the human, from it, the entity.
Okay.
So if the LLC owns the Bitcoin and you get into that car accident, the creditor generally can't reach inside the company and grab the business's assets to pay for your personal mistake.
It limits the blast radius.
Exactly. I saw a phrase in the Reddit research threads we pulled that really stuck with me. Own nothing, control everything.
That's the Rockefeller philosophy, right?
It is. You control the LLC, you manage the wallet, you have the signing authority, you can buy, sell, trade. But on paper, you don't own the coins. The LLC does.
Okay, I have to play devil's advocate here because I feel like a lot of people hear LLC and immediately think tax loophole. If I put my crypto in an LLC, do I stop paying taxes? Am I suddenly offshore and tax-free?
Absolutely not. And I need to be really, really clear about this. An LLC is not a tax shelter. For the vast majority of people, a crypto LLC is what the IRS calls a disregarded entity or a pass-through entity.
Disregarded sounds a bit rude.
It just means the IRS looks right through the LLC and sees you.
Ah.
If the LLC sells Bitcoin for a profit, you pay the capital gains taxes on your personal return. It changes nothing about what you owe the government on your gains.
So if I'm not saving on taxes, why bother?
Well, there is a nuance here, and it's about expenses. If you're operating as a legitimate business, you can deduct business expenses.
Like what?
Hardware wallets, advisory fees, maybe a dedicated laptop, tax software.
Okay, that's a few $100. Nice, but not life-changing.
True. But here's the big one. Scams and hacks. Under the current tax code, if you as an individual get hacked and lose 10 Bitcoin, it is very difficult to claim that as a loss. The Tax Cuts and Jobs Act really limited casualty loss deductions for individuals.
But a business
that suffers a theft or a loss in the course of its operations, that is a much, much easier argument to make.
That is actually a really significant distinction, especially given how common phishing attacks are. Now, practically speaking, if I have 10 Bitcoin on a ledger right now, do I have to sell them to put them in the LLC? Because that would trigger a taxable event, and I don't want to pay taxes just to move money from my left pocket to my right.
No, and please don't do that. You make what's called a capital contribution.
Okay.
You'd essentially transfer the coins from your personal wallet to the LLC's wallet. In exchange, the LLC gives you membership interest, basically shares in the company. It's a tax-free swap.
Okay, so we've got the shield against lawsuits. We've got the tax reality check. Now let's talk about the ghost, privacy. Because I was reading through the notes on the 2026 regulatory landscape, and I honestly thought there was a typo in our research.
About the Corporate Transparency Act.
Yes. For the last 5 years, the narrative has been the government wants to know everything. Total surveillance. No more anonymous shell companies. And then I see this note about March 2025. What actually happened?
It was a massive pivot. I mean, a genuine plot twist in the regulatory world. You have to remember, the Corporate Transparency Act, or CTA, was supposed to be the death knell for privacy.
Right.
It required every LLC to report its beneficial owners to FinCEN, the Federal Financial Crimes Enforcement Network.
A federal database of exactly who owns what. So if you own an LLC, Uncle Sam knows.
But then the lawsuits started flying. Small business associations, civil liberties groups, they sued the government, arguing this was unconstitutional overreach. And in March 2025, FinCEN blinked.
They blinked.
They issued an interim final rule that effectively suspended the reporting requirement for domestic entities. They just rolled it back.
So let me get this straight. If I am a U.S. citizen and I go to Wyoming today to form an LLC for my crypto, I don't have to tell the federal government that I own it.
As of right now, under the current 2026 rules for domestic entities, no, you don't.
Wow.
It essentially re-legalized the anonymous LLC for Americans. Foreign entities still have to retort, but for locals, the privacy game is back on.
That is wild. I feel like that did not make enough headlines. It's a total reversal of the trend.
It is. But, and there's always a but, you have to be careful where you incorporate. Because while the feds backed off...
Some states decided to pick up the slack.
Exactly. This is the state shopping part of our deep dive. I see New York in the notes here, and they look like the villain of the story if you care about privacy.
Yeah, what's their deal?
New York went the complete opposite direction. On January 1st, 2026, the LLC Transparency Act went live. If you form an LLC in Manhattan, you must disclose beneficial ownership. So we're seeing this fracture in the country. Jurisdictional arbitrage is becoming very, very real.
Meaning you can choose the laws that govern your money by choosing the right state.
Precisely. And you don't have to live in Wyoming to have a Wyoming LLC.
Okay, so if I want to play this jurisdictional arbitrage game, I need to know the players. We have the big four in our research. Wyoming, New Mexico, Delaware, and Nevada. If I'm sitting on 100 grand of Bitcoin and I want to disappear, where am I going?
If you want to disappear on a budget, you go to New Mexico. We call it the ghost.
Why the ghost?
Because New Mexico is one of the only states that requires no annual report. They don't ask for member names. They don't ask for manager names. Once you file that initial paperwork, the state effectively stops asking questions. It is a black box. And it's cheap, maybe $50 to set up.
That sounds perfect. Why wouldn't everyone just go there? Why are we even talking about the other three?
Because privacy isn't the only metric. There's also protection. This is where Wyoming enters the chat.
Okay.
Wyoming is the pioneer. They invented the LLC back in the 70s. Their superpower is something called charging order protection.
We touched on this earlier, but break that down. Charging order. Isn't that like a credit card thing?
Laughs. Nothing to do with credit cards. Think of it like a moat around your castle. Imagine you get sued personally. In a weaker state, a judge might say, okay, you owe this person money. I'm ordering you to sell your LLC shares and liquidate the Bitcoin to pay them. Game over.
The moat is dry. The enemy walks right in.
Right. And in Wyoming,
What happened?
the law says the creditor cannot force a sale of the assets. The most they can get is a charging order. It basically gives them a lien on any future distributions.
Yeah.
They have the right to the money if you decide to take it out of the company.
But I control the company, so I just don't distribute the money.
Exactly. You let the Bitcoin sit there. And here's the poison pill. In many cases, the creditor is now liable for the taxes on the profit allocated to them, even if they never received a dime of actual cash. It's called phantom income.
That is nasty. I love it. It forces them to settle because they're getting a tax bill instead of a payday.
It changes the leverage completely.
Okay, so Wyoming is the shield. New Mexico is the ghost. What about Delaware? Everyone talks about Delaware.
Delaware is the suit. You don't go to Delaware for secrecy. You go there for prestige and predictability. If you want to issue shares to investors, or you're building a complex DeFi protocol with venture capital backing, you go to Delaware.
Because of the courts.
The Chancery Court? Yes.
Yeah.
No juries, just judges who understand business law. But for a personal crypto piggy bank, Delaware is overkill. It's expensive, $300 a year franchise tax, and it doesn't offer that ghost level of privacy New Mexico does.
And finally, Nevada.
Nevada is the expensive fortress. They market themselves aggressively on privacy, but they actually do require a list of managers. It's internal, not necessarily public in the same way, but it's there. And it's pricey. You're looking at hundreds of dollars just to get a business license. Unless you live there, Wyoming or New Mexico usually offer better value for the solo investor.
So we've picked our state, we've moved the coins. Now let's loop back to the nightmare scenario. Matthew Mellon. We established that dying with secret keys is a disaster. How does the LLC actually fix that? Because the LLC doesn't have hands, it can't type a seed phrase?
True, but the LLC has an operating agreement. This is the most boring, important document you will ever sign. In a personal wallet scenario, you die, and your heirs inherit the keys. That is a security risk and a legal mess. In an LLC scenario, your heirs inherit shares.
Explain the difference.
The wallet stays exactly where it is. The ownership of the wallet, the LLC, never dies. It just gets new management. You can write a specific clause into your operating agreement that says, upon my death, my wife becomes the manager with full authority.
And that legal authority matters, right? Because I read something pretty disturbing in the notes about hacking laws.
The Computer Fraud and Abuse Act.
Yes.
Technically, if your wife logs into your laptop and uses your credentials to move money without explicit legal authorization,
She could be breaking the law.
she could be violating federal hacking laws. It sounds extreme, but prosecutors can be aggressive.
So she could go to jail for trying to pay for my funeral with my Bitcoin.
Technically, yes. But the LLC structure, combined with something called RUFADADE,
Arufada-A sounds like a magic spell.
it stands for the Revised Uniform Fiduciary Access to Digital Assets Act. It's a mouthful. But it is the magic spell that keeps your family out of jail. It is the legal language that says, I hereby grant this person the right to access my digital existence.
So instead of leaving a Post-it note under the keyboard and hoping for the best, you are creating a legal succession plan.
Precisely. It turns a scavenger hunt into a standard corporate handover. Plus, it helps with valuation. Remember Mellon's estate trying to value XRP while the price was crashing?
Yeah, how do you pay estate taxes on something that drops 50% in a week?
It's a total nightmare. An LLC allows you to value the business interest rather than just the raw coins at a specific second. It centralizes everything. It turns a chaotic pile of assets into a single line item on an estate tax return. 100% interest in Crypto Holdings LLC.
I want to pivot to one advanced strategy before we wrap up. The self-directed IRA LLC. I see this advertised all over Twitter. Buy Bitcoin with your 401k tax-free. It sounds amazing, but the notes here have a massive warning label on them.
This is the third rail of crypto investing. It is incredibly powerful, but if you touch it wrong, you die financially.
Okay, sell me on the power first. What's the upside?
Checkbook control. Usually if you want crypto in an IRA, you have to go through a custodian, you fax them a request, or use their slow portal. They buy the Bitcoin, they hold the keys, they charge you a transaction fee. It's slow.
And checkbook control changes that.
Completely. Your IRA forms an LLC, you are the manager, the IRA wires the cash to a bank account you control. Then you can literally write a check or wire funds to Kraken or Coinbase and buy Bitcoin instantly. You hold the keys, you control the timing.
So I don't have to fax a permission slip to a custodian and wait 3 days while the price of Bitcoin jumps 20%.
Correct. You have immediate execution.
Okay, that sounds great. Where is the third rail? Why is this so dangerous?
It's in the self-dealing rules. The IRS is watching these like a hawk. Because you are the manager, you might be tempted to do things you shouldn't.
For example?
You cannot pay yourself a salary for managing this LLC.
Okay, that makes sense. It's retirement money.
You cannot buy crypto from yourself. You can't say, hey, I have some Bitcoin in my personal wallet, I'll sell it to my IRA. That's a prohibited transaction. And you cannot commingle funds.
And what happens if I slip up? Say I accidentally use the LLC debit card to buy a tank of gas because it looks just like my personal card.
That is the nuclear scenario. It's
Yeah.
not just a small fine. The IRS can declare that the entire IRA has been distributed to you.
Wait, the whole thing? Even if the gas was only $50?
The whole account.
Yeah.
Instantly taxable as income. Plus, massive penalties if you're under 59 and a half. You could lose 40 or 50% of your retirement savings over a tank of gas.
Okay, so this is not for the person who is disorganized. This is for the person who loves spreadsheets and follows rules.
Extreme discipline is required. If you can't keep your personal and business expenses 100% separate, do not open a self-directed IRA.
Let's bring this down to earth. Practical realities. I'm listening to this. I have $5,000 in Ethereum. Do I need an LLC?
Probably not. We have data from Jake Claver, a consultant in this space, suggesting the cost-benefit analysis really tips in your favor when the portfolio hits the $50,000 to $80,000 mark.
Because these things aren't free.
Right. You can DIY a Wyoming LLC for $200, but a proper setup, one with a custom operating agreement that actually understands what a private key is. You're looking at around $2,000 to set it up correctly with a professional.
And then the annual maintenance.
Plus the operational burden. You have to treat it like a business. Separate bank accounts, separate wallets. If you blur that line, if you buy groceries with the company Bitcoin, a judge can pierce the corporate veil and all that protection we talked about in the beginning. It just vanishes.
It's a commitment. You're essentially becoming a professional asset manager for yourself.
That is the perfect way to put it. You are professionalizing your wealth.
So let's recap. We've gone from the Wild West, where you hold your keys and just hope you don't get sued or die unexpectedly, to the fortress. The LLC protects you from liability, it streamlines passing wealth to your kids, and thanks to that 2025 rollback of the Corporate Transparency Act, states like Wyoming and New Mexico are offering serious privacy again.
But it requires discipline. It's not a set-it-and-forget-it magic trick. It's a legal structure that requires maintenance.
Here's a thought to leave everyone with. We're seeing this divergence. The federal government backed off on transparency, but states like New York are ramping it up. Are we heading toward a future where your choice of state residency matters more than your choice of cryptocurrency?
It raises a fascinating question. Is jurisdictional arbitrage the new diversification? Maybe in 2026, it's not just about Bitcoin versus Ethereum. It's about Wyoming versus New York. The code of law is becoming just as important as the computer code.
If you are sitting on a significant stack, remember that 50K threshold. Don't just open a browser tab and start clicking. Consult a pro, get that operating agreement drafted by someone who knows what a seed phrase is, because a template from LegalZoom isn't going to save your estate if it doesn't know how to handle digital assets.
Couldn't agree more. The fortress is only as strong as its foundation.
Thanks for diving deep with us. We'll catch you on the next one.